Hi, my name's Fred Arnold, and welcome to beautiful Southern California and the show Out of the Rough, a show that will help provide you some of the solutions to many of the challenges we all face during these tough economic times. Hi, welcome to Out of the Rough. I'm Fred Arnold, and in this show we'll highlight opportunities and solutions to help get you out of the rough and into success both financially and personally. In these tough economic times, I want to bring to you practical solutions to many of life's challenges. On today's show, we're going to talk about investing and building a secure nest egg for your retirement. But first, let's talk about the real estate market and what's going on with homes here in Southern California. Whenever I talk about real estate, I really talk about breaking it down into three different segments as far as homes go. I like to talk about the entry-level homes as one segment. The next segment within an area would be your move-up homeowner or move-up homes. And the third segment would be your estates, if you will, those more expensive homes. And so when you we'll break down these little areas, I'll talk about them in three different segments. Well, when the housing crisis hit in 2007, towards, I'd say it was August of 2007, the first thing that happened was you couldn't get a loan. It was very difficult to get a jumbo loan. It was difficult to get subprime loans, alternate financing loans. So the first area that got hit in the downturn of our economy is the entry-level homes. Now, those homes were going for a lot of money. They were really inflated values. In some areas, $500,000 entry-level, 3-bedroom, 2-bath homes here in Southern California. Well, many of those individuals that were in financial difficulty because they lost their job couldn't hold on very long. So we saw that market just plummet rather quickly and values drop, and then they ended up leveling off. And let's say an entry-level home was going for $550,000, which throughout the country seems crazy, but here in Southern California it doesn't. And it leveled off around $350,000. The reason why it leveled off sooner than the rest of them is because they got hit first, number one. Number two, when they leveled off, it became advantageous for investors to buy those homes and break even if they are renting them. So it became a great alternative to the stock market and other investments. So we saw a leveling off of those homes recently. And last but not least, the fireman, the doctor, the nurse, the hardworking family that was locked out of the home buying process was now able to afford a home at those lower end values. And so we saw those values plummet immediately, and the leveling off of values in that entry-level homes. As far as the move-up homes, the homes that were going for, let's say, $500,000, around $700,000, let's say $500,000 to $850,000. Those homes took a while to start dropping, and the reason why is many of those individuals that lived in those homes had more reserves. Maybe that economic group, if you will, had better financial means to weather the storm. In fact, many of those higher-end homes, those individuals had less subprime properties. They had more of the conventional home loans, if you will. And so those values finally started coming down about 3 to 6 months after the entry-level homes. They started going down, and they've almost hit the bottom. They've almost hit the bottom because somebody's selling their home, their first home, and moving up. Now that house is affordable. And so we're almost seeing a leveling off of home values in that market. Let's talk about the higher-end homes, because those homes, $1 million plus, did not get hit here in Southern California till about October of 2008, a whole year after the rest of the market was really significantly affected. And the reason why is those individuals usually had much more financial means to weather the storm and weather the downturn. And many of those individuals, possibly they own their own business or are executives in company, and they didn't see the layoffs immediately like we saw the layoffs in those that were in entry-level homes or the move-up homeowners. So we're finally seeing a radical drop, if you will, over the last 12 months of those values. Now, I don't know if we've seen the bottom of those particular values here in Southern California. In fact, when you look at different submarkets within Southern California, it's argued that in, for example, Santa Clarita Valley, that the lower-end housing market is kind of leveled off and is now bouncing around the bottom. The move-up, the middle home values are kind of dropped, leveled off and are bouncing along the bottom. And the higher end homes are still dropping a little bit. So it's just a matter of finding the right home if you are shopping in any one of those particular segments. From what I understand in the San Fernando Valley, those middle end homes still haven't seen quite the bottom. Of course, I do anticipate that we'll see the bottom of those home values. Now, when I talked about submarkets, I want to talk about another thing is, how new is your neighborhood? I refer to homes that have been around a long time as established or old money. And I don't mean old people live there. I mean that those homes have been there a long time, and many of those loans are seasoned. They weren't subprime loans because people living in those homes that were built 20 years ago, people have had an opportunity to live in those homes 20 years ago, 10 years ago, and 5 years ago. So it wasn't like a new home community where there's a lot of new financing, creative financing that happened in 05 and 06 that we see in those new construction areas. We see the new construction areas have more foreclosures and short pays and distressed property because of that dynamic. The fact that there was less seasoned loans than there are in the old money areas, if you will, or those more established neighborhoods. Last but not least, I want to talk about is what happens to home values when they've hit the bottom. Because we've talked about the fact that the entry-level homes kind of hit the bottom, bouncing around on the bottom. The middle-level properties, the move-up homes are bouncing along the bottom, and the higher ends are close to the bottom. What happens when they hit the bottom? Well, in every housing correction in the last 30 years, when it hits the bottom, it doesn't necessarily go straight up. It bounces along the bottom for a couple years. And so one month you might see your house worth a little bit more, 2, 3, 4, 5% more. And the next month, maybe a little bit less, depending on what inventory comes on the market. Now, it's going to take us at least 2 to 3 years to see any significant appreciation in values for one reason, and it's one of the keys to it, and that is loan modifications. Because if somebody gets in trouble in this market, they figure, well, I'll just get my loan modified. Even if they probably shouldn't be in the property, they try to get a loan modification because that's something we're really pushing as a, I almost want to say as a society. It's become like acceptable to do a loan modification, and in some cases people qualify. So we're seeing a lot of those that would normally sell real quickly and get out or have a foreclosure kind of postpone that foreclosure process, trying to save their home and get a modification. Those homes will either be paid on time with the modification over the next 12 months, or those people will fall back and default, and that house will eventually come on the market. And so I think we're going to see a stringing out, if you will, of this market for several years, when it would have normally really, values would have come down really even harder than now, but then rebounded a little bit sooner. We're actually going to see the bottom of the market bounce back and forth for several years because of that dynamic. I hope this helped explain a little bit about where we are in the housing, this very challenging housing crisis. But in all crisis, I believe there's a huge opportunity to get into a home of your dreams, or get into the first home that you were looking to buy some time ago. So a little insight on that. We're going to jump to a quick break, but when we come back, we'll have Dennis DeYoung, an expert when it comes to financial planning, and we're going to talk about how to prepare you to grow your nest egg for retirement.